Good morning. Good morning. How are you? I'm just getting ready. Let me know you're here. I sent you some documents. We're going to start the new module or the new material. 3.1, the document is has the notes. I'm just looking which chapters. All right, so this covers chapters 5 and 6, okay? Okay, I think I'm ready to go. How's everybody today? Good morning, good morning, good morning. So about the tests, I will get those graded as soon as possible. The TA is working on that. I'm debating giving you solutions. It just makes my life more difficult if I'm to give a test again. But I guess I have to create more tests. That's the one disadvantage of giving classes online from my perspective, is that I have to create more tests because they can easily get shared and distributed. So yeah, I think I have to give in and give you the solutions for the questions, so you can study from them and prepare for the final that is cumulative. All right, so this is going to be covered in chapters 5 and 6. You may have seen this before, this topic. We're going to go very deep with this topic, más profundo, okay? If, are there anybody, I asked before, is there anybody here who took my class? 3106, I covered this in 3106 as well. You can let me know. I should be able to recognize names, but I haven't recognized any lately. So, what we're going to talk about next is essentially it's alternatives to using net present value rule. Alternatives to the net present value rule. The net present value rule was used to determine whether you should pursue an investment project or not. And the idea there, we're going to review it. So let's see, let's just get into that. Everyone has their notes, right? Anyone who doesn't have their notes, please let me know, so we can resolve that at the beginning. I'm going to talk about NPV first. So let's recall what NPV is. Where the net present value rule, NPV, is equal to, hold on, I'm annoyed by the unevenness. I'm very sensitive to lines. All right, let me make this a little bit bigger too. So, net present value rule is looking at the benefit and the cost of a potential investment opportunity. The benefit would be the present value of future cash flows offset by the initial investment that costs a negative, right? All right, so till now, you've been given problems about NPV where I give you the cash flows, right? I give you the cash flows, and using the cash flows, future cash flows, you can calculate the NPV. Now, you have to think about where those came from. Where did those cash flows come from? Well, given that you're looking or projecting, the possibility of pursuing a project in a company, they'd have to consider estimating the initial cost. Now, they could have an estimate. Let's say the project was to open another branch. So you have a consulting company, and you're thinking the consulting company in San Juan should be replicated in Ponce. So you have an idea of what that will cost you, but you don't know for sure what it's going to cost until you really get doing it, right? But you'll do your best. The company would do its best to estimate that initial cost, and then looking at potential future cash flows as a result of doing that, opening a branch in Ponce. And in the process, you have to think about how much are those cash flows going to be and when do you expect them. And then to discount those cash flows, you have to determine what would be the appropriate discount rate. What should be the I used to discount those cash flows? Okay, so we usually say that if we weren't to pursue this project, then we would invest those amounts. We would invest or finance another project with an expected rate of return that we would like. So that's the one we should use. Or maybe we would just deposit it in an annuity and watch it grow for our retirement. Okay, watch the amount accumulate for our retirement. Something like that. So whatever the return that we expect with those amounts, with that capital, that's the interest rate we should use. Okay, so that's NPVs. That's a little background to NPV. Going deeper into NPV. If you can't see anything, if you cannot see anything, you should refresh. Okay, refresh your screen. It's visible. Any point, if things get blurry, refresh. Refresh if blurry, or if or if you get a black screen, because some students yesterday in another class complained about a black screen as well. Okay, does that work? Can you let me know if that worked? Okay, so looking at these cash flows and this potential investment opportunity, in this case, the example I gave to open a second office, then you could consider that project all on its own. It's very strange. Everything works on my side, Jean. Just reboot your computer. I don't know. Use a different browser. It looks perfect for me. Use a different browser. Looks kind of pixelated too. All right. So if you were to just analyze that project, whether you should do it or not, then you would use the regular NPV rule. You would check if NPV is positive, and that means that the project is profitable. If you were comparing that investment opportunity with another one or many more, so either we expand and open an office in Ponce, or maybe we do the other things I mentioned, the other alternative investment opportunities. We take that capital and we put it into a retirement account for the staff in the company, or the executives in the company, or we take that money and we invest in somebody else's company. Okay, whatever we do, we compare it to other projects, then what we're doing is called a mutually exclusive project analysis. So in that case, what you do is you calculate the NPV of each project and you rank them. The one with the highest NPV, if you could only afford one, then you pick the one with the highest NPV. Now there might be instances where you can afford more than one, and I'll refer to those as problems of capital rationing. We can afford then more than one project, but not all of the projects. Then we have to ration the capital. Okay, the capital, the amount of financing that we have. Okay, so that's the NPV. So let's look at an exercise. Well, I'm glad you can see it, Jean. When I see Jean, I want to say Jean in French, but I'm going to say Jean unless you correct me. I think that's how you want me to say it. Let me know. So here's the exercise. Here's an exercise. What if... Oh, wait. Is this down here? Oh, okay, here it is. I have to remember I have these on 2 slides a page. So is everybody here with the right pages? So you want me to say Jean? Jean. I like French. Okay, back to work. So here we have an independent project analysis as an example. So I'm going to review the alternatives to NPV also as independent project analysis, and at the end, towards the end, I will talk about mutually exclusive projects and capital rationing. Okay. Yeah, because I see your last name, Durieux, is also French. Okay. Back to this again. Have to stay on track. Okay, assume you have the following information on project X. This is the initial outlay, and the required rate of return that's been pre-established is 10%. So that's what we're going to use as our I. Annual cash revenues and expenses were computed and estimated to be these numbers here, revenues and expenses for a net revenue, so that would be calculated like that. So we would draw a timeline and then compute the NPV of the project, right? Using the CF keys to get our final answer. So this is the idea, right? Each cash flow needs to be discounted back to time now, so I can add all of these together. So I need to take into account time value of money, when I do this. The calculator would do that automatically for me, so I can just enter that into my calculator. But in a test situation, I would have to write this out, right? This whole formula here needs to be written and your final answer. So the final answer, to get it in our calculator, I provide you with the slides. I give you a slide here where you can make yourself a note if you forgot how to enter that into the calculator. So remember, you hit CF. Oh, I can do this. I can do this because I have a calculator here. Okay, can I get the calculator out? I'm going to hit CF and clear work just in case. Second, clear work. Great. And then enter these values, right? 1,000. Enter. Ah, that's not right. I did that wrong. Clear that. Clear that. CF. The first one is 1,100 with a negative in front. So let's do that again. Now enter. And then enter the cash flows. And I'm going to use the net revenues. 500. Enter down, 700, and oh, what's that? That's not it. That's a frequency, and I just want 1. So let me fix that. Let me clear that again, all over again. Okay, so CF0, negative 1,100. Then the first cash flow is 500, and then I just put 1 in there as one of those. Now onto the second cash flow, 700. Enter down one of those, so for frequency, and then the third one, 500. So there's a negative cash flow at some point, which is fine. One of those, and then 1,200. Enter down and one of those, and then we ask for second. No, do we ask for second? We ask for NPV. We hit NPV and it asked for the interest rate. We decided we're going to use 10, enter down, and then we asked to compute NPV and get this answer. Hope that wasn't confusing. I made common errors, showing you how you can make those errors too. So see if you can get that on your calculator and let me know. Or if you want me to do it again, I'll do it again. Okay, you guys are getting it. Okay. So that's that. That's a review. Okay? So you can have negative cash flows, but it works out to have, in the end, it turns out that the net present value, the benefits offset the cost. So it's worth it to you to invest in the project if this is all you're going to consider. So this is called independent project analysis. We're evaluating the project on its own merit. We're not comparing it to someone else, some other project. Okay, so with that review, I'm going to go back to the introduction and tell you what we're going to do is look at alternative valuation techniques. Techniques for valuation of alternative capital investment projects. So we're going to use alternative techniques to evaluate various projects. We're going to do this either evaluating a project on its own merit, an independent project analysis, comparing projects and picking one, that's mutually exclusive project analysis, and capital rationing, we're going to look at that as well, where you can afford possibly two or more projects, and you have to choose. The independent project analysis is a matter of accepting or rejecting one project and this does not affect decisions of other projects, okay? What you do, just like the NPV, is you need to find if whatever it is, whatever technique you use, either the value you arrive at should exceed a minimum. For the NPV, for example, it has to be greater than 0. We're going to learn other techniques where the criteria set out, the number that you calculate for that criteria shouldn't exceed a maximum. So the example for that is what we're going to talk about, the Payback Period rule. And I'll explain that shortly. So the other thing to do is you could evaluate for picking only one of several potential projects. Okay, so you're going to look at the benefits versus the costs of a variety of accounting systems and pick only one of them, not all of them, because they're the same thing. In this case, you rank all the alternatives, given the technique you use, and select the best one according to the criteria. And finally, in capital rationing, that's a different kind of a question. That's where there's enough capital to invest in more than one project, but not all projects. How do you choose? That's what we're going to look at. And we're going to, the focus is going to be not only making these calculations using different techniques, it's also which techniques are appropriate for the various types of questions we face. All right, so we did the NPV. This page here is just some room for you to make notes for yourself, either on your iPad or on paper, of how you did the calculation and maybe warnings about where you could go wrong if you made some mistakes. Okay, so that's NPV. What about the next rule? This is So this is a common question that investors or business owners will ask their finance team, or this is the question that they're going to ask themselves. How long does it take for the project to pay back its initial investment? So money has to be put up, and whoever has to put up that money wants to know, when do I get my money back? At least that, never mind profits, when do I get my money back? And rather than looking at the dollar amount in terms of NPV, we're interested in the number of years or at some time period. So let's say if the person wants it to return in months, then you would use, number of months. But the standard is the payback period is known as the number of years to recover costs of a project. If the project is being evaluated on its own merit, so is a project profitable within a pre-specified period of time, then what you're doing is an independent project analysis. So you could say something like, if the project doesn't pay back in 2 years, then we're not going to take a project. Or you could say in a half a year, it has to pay back, or you're not going to take on the project. Alternatively, let's say you have many alternatives to look at. And you compute, you do some estimates, you pull together some data, you make some estimates. And we're going to do this. After we review the alternative techniques, we're going to actually go to capital budgeting, where you use the information I provide you. I gather a bunch of information, I give it to you, and you determine the cash flows. Right, but not here. Here I'm going to give you the cash flow, so we're going to focus on learning the techniques. So let's say you have done that for a variety of projects, and you have to pick the best one. So maybe you line up all the information, and you say, well, I'm just going to pick the project that pays back quickest. But it has to be within a period of time. So let's say within 2 years. Okay, so you specify, comparing all of them, we're going to take the one that pays back first, but it has to be within 2 years. Otherwise, we're not going to do any of these projects. Okay, I saw buffering. Okay. Weird. I'm just checking something from here. Okay, I don't know. I'm not sure. Just refresh if you hear me. If you don't hear me, refresh. Okay. So what's the problem with this rule? What can people tell me about any problems? Like, maybe you never heard of this before. All you've ever heard of is the NPV. Now, there's a reason for that. There's problems with this rule and the other rules I'm going to show you. There's problems with NPV as well when you compare them, but NPV turns out to be the most reliable. So that's why you learn about it. Well, what's the issue with the payback period rule? Can anyone tell me? There's two major issues. There are two major issues. Nobody? No comments? One is very obvious when you, oh, here we have a comment. Okay, so yes, Voin Marie says that if you're just looking at the years in which, you know, the years before your threshold, your cutoff for paying back, you've ignored the future cash flows, which could be extremely high positive cash flows that you've completely ignored, or they could be very low or negative cash flows, which you've completely ignored. So that is one problem, that you're just focused on the years that you've predetermined you want the project to pay back in. And another one is that you've completely ignored time value of money here. Like, I haven't done anything to account for time value of money. So we're going to look at the second issue first. And where I refer to the payback period rule like this. I write it like that in some of my notes. So that's the payback period rule. And then there's the discounted payback period rule. Okay, that's what we're going to talk about. We should be discounting these cash flows before we evaluate them. It will make them smaller and less likely to have the project pay back, but they're more accurate. Remember to refresh. Yeah, I don't know why it's doing that. I don't know why it's buffering. I have my Ethernet connected. It might be your connection. This one, make sure it's, yeah, that's already set. Okay. So what was I saying? So these are the cash flows from a project. For our first example, the initial outlay is $1,000. And we're going to have so this is another term for required rate of return, right? Cost of capital. So you should recognize that also as terminology for I, or the interest that we're going to use, the discount rate. So the cash flows should be discounted. So that's what this is here. Let me make this a bit bigger. So this is equal to 200 divided by 1.1. And sorry, this is equal to 200 divided by 1.1. And this is 400 divided by 1.1 squared. And this one is 700 a space. Right? Good morning, Gabriel. Okay, so Juan, you're saying there's problems with the internet on the island. Is that what you're telling me? Or yours? I use AT&T, if that provides any information. Okay, so then what I want to do is, I have it below, but I'm going to recreate it here. So we're going to make a column for cumulative discounted cash flows. So what I'm going to do is I'm going to add as I go along. First year it's 182. The second year it's going to be a sum of the first two, 513. And then I'm going to add onto that the next one. So I'm adding 182 plus 331 to get 513. Now I'm going to add 513 to 526 to get and then I'm going to add 1039 to 205 to get 1244. So that's the column of accumulated discounted cash flows, which is also below, but I like to put it on the side so you see where it came from. Okay, that's how I added. Now what do we do? So this is the discounted payback period rule. I found out for $1,000 investment, it takes until somewhere between the second and the third year to pay back the 1,000. Now I want to be precise about that. It's going to be 2 point something. So the something is going to be a matter of looking at that third year. This is the third year. And what we make in the third year, or the cash flow anticipated that year, that's already been discounted. And the remainder that we need to make 1,000. Okay, so this is the calculation. We need to get to 1,000 minus what we already estimate we recovered, divided by how much in the third year. And this will get us as close as possible to the point in time where the project pays back. If you're using the discounted payback period rule, you do it like this. If you're conducting the payback period rule, you just use this column. So what would be the payback period? So you'd have to do the accumulated cash flows. So that would be It would be 200, 600, and then again, somewhere between 2 and 3. So you would have to do 2 plus, and then over the third year, it's 700. The remainder would be 1,000 minus 600. That's how you would calculate the payback period. So what would it be? That's 1,000 minus 600. Okay, so it's a little bit, it's smaller, right? When we discount, it makes it less likely that we're going to pay back in the time period because we're discounting, the cash flows are becoming smaller. I should use a different color to circle. Okay. Any questions? So how do we conclude? We can't conclude unless someone tells us what the payback period, the threshold or the cutoff is. So I will say so if the cutoff was set at 2 years, then you would have to reject the project. If the cutoff is set at 1.5 years, then you would accept the project. Which one you use of the two, we'll see at the end. I'm going to compare all the projects, all the techniques, and look at what CEOs do use. I think this is, because it's just like what they call a back of the envelope calculation. It's just a rule, it's a quick rule of thumb. The calculation is just made very simply using the estimated cash flows for the payback period rule. If you want to be more specific and discount, you'd use this. But it's less likely you will accept the project if you use the discounted payback period rule. So if you want to be conservative and not so, you don't want to spend a lot of money, you might always want to use this rule to say, well, let's not pursue this project. Look at the discounted payback period. All right, just giving you an idea, the differences and similarities. So as we said, and as was pointed out, there are problems with this. So we resolved one of them where we weren't discounting the cash flow, so we took care of that. But notice we didn't include, even though it's here on the paper, on my sheet, we didn't even include that in our consideration. We didn't use that number at all. And that's an issue. So, what are the issues with the discounted payback period rule? First, the maximum acceptance criteria is set arbitrarily by management. So like I said, if you are more conservative, you don't want to accept projects, you don't want to spend money on projects, you'd rather have cash for the company available, then you're going to use a discounted payback period rule, and you're going to set a high bar. You're going to say many years. You're going to be a tight bar. You want it to pay back sooner than possible, and that's just arbitrary. That's not what it's not a set objective rule. I think that's the big problem. And the other one is that you're ignoring cash flows that might be important. The one cash flow that we ignored was the highest of all of them, and it's happening in the 4th year, and it didn't even go into our calculations. So NPV would be a correction on that, because NPV uses all the cash flows to arrive at a number objectively. Now, there's lots of subjectivity in this already, because the person who's doing this analysis, they have to estimate all these cash flows. They have to come up with the right required rate of return. There's lots of estimating going on, and lots of assumptions. So it's nice if your rule can be objective. So it could be that a future cash flow that you've ignored is a loss anticipated in the 4th year. So let's say you anticipate that there's going, the example that I gave, we're going to expand and have a consulting office in Ponce, but we know in the 4th year or the 5th year that we have to do some renovations because there's some laws changing, and we have to make certain adjustments to the building that we found to protect against natural disasters, so like hurricanes or earthquakes, and we know that expense is coming, and we might just completely have ignored it. Or what if there's maybe there are losses up front in the early period, but in the 5th year or 4th year, maybe there's windfall cash flows. So millions of dollars are anticipated for your project returns, and you've completely ignored it because it doesn't pay back soon enough. So you have to consider your priorities. Is it that it has to pay back soon because you're going to lose the faith of your investors or your clients? Or is it that they're in for the long term, and you can wait for those cash flows, and so you set a higher, more years as your cutoff. Okay, so that's what I'm going to say about payback period and discounted payback period. So far we have NPV, I'll say number of periods, for payback period rule, and the number of periods for discounted payback period rule. The next type of someone's correcting me. I'm sorry, I misspoke here. If the cutoff is 2.5 years, I don't know what I'm saying. There. If the cutoff is set at 2.5 years, accept the project you could accept the project under the payback period rule. can make this 2.6 years. So it works. Sorry, correct that on your notes. So questions? Sorry, Tiana. Is that all right? So you could use that, but then you would have to reject under the discounted payback period rule. It doesn't meet that criteria. All right, so the next rule, NPV uses dollars. Payback period rule and the discounted one use years or periods as your metric, as your measure. What about percentage? The internal rate of return is a rule, or it provides us with a rule that can be used to determine if we should invest in a project or not, or which projects we should invest in if we have to choose. I'm going to come back to this slide at the end to summarize. Okay, this is more of my summary slide, but I put it here because this is where we're heading. We're going to spend some time on the internal rate of return. The internal rate of return is the break-even discount rate. It's the discount rate that sets the NPV to 0. It gives us a measure of the return on investment for the project as a percentage. It's one of the reasons, probably the main reason why I had you buy the finance calculator. Okay, that and also finding rates of return for bonds. So that's why we use the finance calculator. The way we're going to use this figure is we're going to take the internal rate of return that we calculate and we're going to compare it to the required rate of return. So this is how I'm going to write it. So this is like your cost of capital, or the I that you've set out for your discount rate. So again, that's the number, that's the rate that if you weren't investing in this project, you would be investing in another project expecting that rate of return. And it has disadvantages, and we're going to work on correcting those disadvantages, and then I'm going to recap. Okay, so let's do an example. So here's my investment project, and I specify that, you'll see that I distinguish that from other types of projects. So this is called an investment project because the first cash flow is a negative and the rest are positive. Juan has a question. Would it be correct to say that the IRR is a guideline established by the company who is investing? Do you mean, so this is, okay, the way we're going to see this is this is a company, and this is a project that they're going to undertake. So they think that it's going to cost them, you can think of these as thousands of dollars, so this would be $2 million, all right? So they're going to invest $2 million and they expect these returns later. So just to imagine that I'm using small numbers just so it doesn't get unruly in putting them in the calculator. But you can think of this as like $2 million, 200,000. And then these are the expected returns with a nice windfall in the 4th year anticipated. So what we want to know is what is the return on investment? You could calculate the NPV of this project and test and check it. But an alternative to the NPV, an alternative to the payback period rule, this wouldn't pay back, it would pay back in the 3rd to 4th year. And and I can just do that very quickly looking at the numbers, right? It'll pay back, it will pay back in 4 years, but between 3 and 4 years. So I see that by just adding these together. An alternative to that is say, what is the percentage return on my investment? And is it good enough? All right. Did I answer your question, Juan? IRR is a return on investment on the project. That's how you can interpret it. So if we were to do what I prescribe, let's find where we break even. Where does the project break even? So we set the NPV to 0, and we try and find the interest rate that does that. You can also write it like this, and writing it like this says, I want to balance this amount of future cash flows against the initial investment. And notice, if you just add them together with IRR equals 0, if you set it to 0, the right-hand side, that's what this means. Or let me not introduce another acronym. Let me just write future cash flows without discounting. They sum to 3,800, okay? And obviously we don't want the project to have a 0 internal rate of return. That says that it says the percentage return is 0. So obviously we're going to put higher and higher numbers in here. If we were to do this, we couldn't solve this analytically. We cannot isolate IRR on one side to solve for it. In other words, this cannot be solved analytically. It needs to be solved through iteration. Your calculator will do iterations, and it will enter different values for IRR and see if it's approaching this amount. Or in this case, it'll offset it by 2,200 with a negative in front and see how close we get to 0. So iterate means it's going to put different numbers in there. So we'll try something higher and higher each time. So then it will try, 10%, 20%, 30%, and go towards the discount rate that is equal to 2,200. That makes this right-hand side of cash flows equal to 2,200. Okay, so each time we increase the internal rate of return, this total goes down. Does everybody get that? That's the main point. As I put higher numbers of the internal rate of return in there, just different discount rates, this whole thing on the right side will go down, approaching 2,200. So let's do this in the calculator, and then I'm going to go back to what I'm talking about in a minute. Okay, let's put this in our calculator. The way you put it in your calculator is enter it just as you would the net present value. Okay, so let's go to the calculator and enter it as though we are entering for the net present value. So you hit CF and you clear. Second, clear works. So that's clean. Now, 2200 negative is the initial cash flow. So I enter that and go down. The first cash flow is 800. Enter down with a frequency of 1. Then the next one is 900. And the next one is 500. Enter down, down. And then 1,600. We're done. So look on your calculator. Do you see IRR? If you just press that, that's what you get. So the IRR is not 0. You have to ask the calculator to compute it. And there you go. If I did this correctly. That's what I get. Everybody get my number? You could also ask for the NPV, but what will happen when it asks for the NPV? Or when you try and get the NPV, what's the problem with that? So again, I've left this page free for you to make notes about what I just did. It turns out that the internal rate of return is 19.5%. Again, if your display gets blurry, just refresh. Okay, let's do it again. I might have made a mistake. Okay, let's do it again together. Because I don't know, 19.5 seemed weird. Let me check my numbers. Let's go. Let's check that I entered everything properly. So CF was negative 2,200. C1 was 800. C2 was 900. C3, oh my goodness, I entered the wrong value, 500. And C4 is 1,600. Sorry for the mistake. But anyway, at least you get to see it again. Okay, so then I got all the numbers in there, and I say IRR and then say compute. So 23.29 or 23.3. See, yeah, it makes more sense to me. It looks more like the numbers I remember. So 23.3. So let me fix that. 23.3. Okay, and then I asked you find the NPV. What's the problem with that situation if I say find the NPV? So if I ask you to find the NPV, I'm asking you find the NPV of the cash flows you entered. The problem is, what discount rate do you use? I never gave you one, did I? So what I'm saying to you is the IRR provides you the return on investment without a preset discount rate. To interpret it though, you would like to have you would like to compare it to a discount rate. You have to say, well, this is our return on the investment. This is the internal rate of return. That's the return for the break-even project. And that's better than, you would compare it to the required rate of return. If you didn't want to do that, at least it provides you with a threshold. It provides you with a benchmark, something you need. Well, not a benchmark, because the benchmark would be the discount rate, which this one is beating. Okay, so this is telling you that the internal rate of return is 23%. In this class so far, have you ever seen me give you a discount rate more than 20%? Okay, the stock market returns 11% on average, and it has historically. That could be a discount rate for 20% going into risky investment project. It's not unusual for someone to set a 20% required rate of return. But the point is, for this exercise, I can calculate IRR without a predetermined discount rate. I can get it. But it's kind of useless. It's useless to me unless I can compare it to the discount rate. So but we still need the required rate of return to compare it to. So this is my new symbol for the discount rate. Okay, so there's the internal rate of return. Whenever I ask you to calculate it, you have to put this expression down. Notice that neither of these, okay, so this one or this one, neither of these are equal to the IRR. You got that? IRR is inside the equation. So at the very most, you can put something like IRR in a colon. But don't set that equation equal to the IRR. If I'm grading that, I will take a mark off or half a mark. Okay? The IRR is inside the expression. So what do we do with this number? Depending on the required rate of return, if the required rate of return was 20%, so let's do that. Let's set this is the lingo we're going to use. This is the language we're going to use. If the required rate of return is 20%, since the internal rate of return is greater than the required rate of return, we would accept the project. And I can make a bunch of ifs because I didn't preset one. But the point is, this is how you would make the comparison. If I'll put it in a different color beside it. No, I'll make it blue. If the required rate of return was 25%, since the internal rate of return is not greater than 25%, you reject the project. So it depends. So some people don't like, well, it's not that there's uncertainty. There's just two ways to look at it, right? It can be greater or smaller than that. So there's two possibilities without a discount rate. Usually I'll give you one. But really the beauty of the internal rate of return is that it gives you a range of values to accept the project. So as long as the internal rate of return is bigger than the required rate of return, you will accept the project. Okay, so this procedure that the calculator is carrying out can be replicated by you, which is what we can do here. Don't erase what's in your calculator. All I want you to do is set, we're going to calculate the NPV. I want you to set different discount rates because I didn't pre-specify one. We're going to generate the NPV profile. So I'm going to create this table using the calculator. So what I'm going to do is I'm going to start with 0. Enter, and I'm going to ask the calculator to get the NPV compute. So when the discount rate is 0, the NPV is 1,600. So that's what I just did. Let's do the next one for a discount rate of 5%. So back to the interest rate. So I'm going to make that 5%, enter, down, and then compute again. It's $1,126. Let's see, let's confirm that. $1,126.47, correct. So continue in this fashion, generate this entire NPV profile because I want to demonstrate something to you. So the next one, go back for the interest rate and enter 10%. 10, enter, down, compute, $739.55. That's the next value. Now for 15%. %, enter, down, compute, it's $419.74. Okay, so do the rest. And what does this achieve for us? Let's take It's 10:30. Wow. Let's take a 5-minute break and I'm going to ask you that question when we get back, okay? Let's take 5 minutes. I'm back. Long break. Okay, so my question was, what do we see here? Did you all generated the NPV profile, and you see, as I explained, entering more higher and higher discount rates, the cash flows, the future cash flows go down, down, down until they cross zero. And that's the most important thing. In here, NPV will have hit zero. And that's where we find the IRR. Okay? So the calculator, what the calculator would do is then take this as a new interval and repeat the process but expanding between 20, 21, 22, 23, 24, and 25, and computing the NPV each time. And what you really care about is if it's negative or positive. So our IRR was 23.3, so it's in here. So these will all be positives if you were to enter them, and then this will be they'll all be positive until here, then this turns negative. And then you would have to go between 23 and 24. So the calculator will just do a few of these and iterate, expanding or narrowing in on the place where the NPV is zero. Okay? So then it'll just repeat that. It will go I'm going to tell you guys this now. I assume you understand what I'm saying. So then you'll go 23.25, 23.5, 23.75, 24. And do the same thing. Discount rate, NPV. Each time computing the NPV. This one will be positive, this one will be positive, and this one will be negative. So when it gets a negative, then it knows it's between here and here. You get it? So this is iteration. Then it'll add another decimal place, and it'll narrow in towards the 23.3. That's iteration. Iteration? The iteration or interpolation. I don't know if that's the right word. It's an iteration. It's a computer process to solve. It's not analytical. Okay, so what does this show us? When we use our calculator, we can get the number. So you're probably like, why is she doing all of this? Sometimes your calculator will not give you the answer, and I'll give you examples when that happens. Or if you don't have the calculator, this is how you have to do it. Also, sometimes I'll ask you just to do this. I'll ask you for the NPV profile, and you have to do this. So this is what you need to do. Okay? So as long as the rule is, as long as the internal rate of return is greater than the required rate of return, you accept the project. So you accept here when internal rate of return is 15 because 23.3 is higher than that. You reject it if the required rate of return is 25% because 23.3 is not higher than that. Any questions? Bon Mari, I don't know what your comment means. Would you like to ask me another way? The initial outlay is $4,000 for this problem. So this is the next problem. Oh, iteration, tanteo. Okay, thank you. Okay, so we're continuing with the independent project analysis. Notice I only talk about one project at a time. Here the initial outlay is $4,000 and then the future cash flows are all negatives. When this is the case, we call this project a financed project. So maybe we borrowed $4,000, or you can think of this as $4 million. And then we have to conduct our project, right? And pay back or return the financing, return the amount borrowed. You can think of this also if these are, this is an event, or this is an event for members who have paid their fees, and these are the fees that have been accumulated. And then this is a 3-year fee, let's say, and then these cash flows are as a result of providing the service or hosting events over the next 3 years. So this is a finance project. This is going to be different from this investment project. The investment project, if you notice, we started with our with our NPV profile. As the discount rate increases, or the denominator increases, the overall number decreases, the NPV goes down. That would be graphically a downward sloping curve. And you see here, it would be a smooth curve, right? It's a function. This would be the polynomial function. Goes down as I increase the discount rate, it becomes more and more negative until it crosses here, and this is where the IRR is. So that's nice. It's showing me where the IRR is, but it's also showing me a whole range of values where NPV is positive. And when NPV is positive, I know I accept the project. So without a discount rate, but using different discount rates, I can generate this NPV profile and demonstrate a whole range of values over which we should accept the project. As long as the discount rate is in that range, we should accept the project. So let's say you didn't have, that you had those cash flows that were estimated, and you're looking at conducting the project, which involves opening a second office in another city. This says to you, look, as long as your discount rate, let's say you don't know it, but as long as it's less than 23.3, you should go ahead with it. And you're like, well, sure, it's more than I would ever have set the discount rate to be, so it's going to be fine. Okay, discount rates that we use in this class for project analysis are commonly below 20%. It's not uncommon. So for this analysis of this finance project now, the signs are reversed. The NPV shows, if I was to put in discount rates going up, the overall number would be going down, but notice these are negatives. So even though I'm putting a higher and higher discount rate, the overall number goes approaching a smaller negative number. So it's approaching 0 from the negatives. Get it? So just like the process is the opposite with the cash flows, the graph will also be the opposite. If I show you the graph, you see it's upward sloping. And only in here where the NPV is positive should you accept the project. Let me go back to the calculation. So let's calculate this let's use our calculator first to get the internal rate of return, and then we'll do the profile together. So let's get the calculator first. Let's enter these into our calculator. So we hit CF, we have to clear, second clear work. So you enter 4,000, enter down, and then begin with the cash flows. So let's go through them, make sure I got them right, because I got them wrong last time. So the first one was 1,200. No, first one is 4,000. It's a positive. Then it's a negative 1,200, negative 800, and negative 3,500. So then I ask for IRR and to compute it, and I get 14.37. Okay, so for the test situation, you would have to write one of these expressions. I usually like this one. And then just that the answer is 14.37%. Now we can do the same thing with the NPV profile. We have all the numbers in our calculator. We can just put in the different discount rates. So let's do that. So what I'm going to do now is go to NPV and enter 0 NPV compute. So the first one would be 1,500 negative, which it is. That's correct. Now let's put 5% in. So now I'm going to tell it, go up, put the new discount rate 5%, enter down and compute. Now I get negative 89191. And so on. Okay, so you generate all of them. 10%. I hope you guys are doing this so you remember, okay? Don't just watch me. So then you enter 10, enter, down, compute. So 381.67. Okay, and what you'll see here, now that the next one, the sign will change. So between here and here, your calculator will begin to iterate between 10 and 15. Trying to get closer and closer. We know it's going to be here because we already did it. Okay, now, so we know how to get it. I can go back and do the other two, 15 and 20%. So I put in 15. Right, so there's the positive 50. And then I can also put the 20. But I know it crossed already, so I'm actually done. So it's 418. So I get those two numbers, 50 and 418. Okay. So it crossed in here. So the discount rate is in here. So you got to go closer. You have to expand. And you would see these are all going to be positive. Sorry, these would be negative. Negative, 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 negative. But 15 will be positive, and you know it crossed over the line. So this works because the function only goes in one direction. In this case, it's upward sloping. Also, because it goes in one direction, we know there's only one area where the NPV, or one side where the NPV is positive. Since this is a finance project and the funds are acquired up front and then dispersed, we interpret the rate that we found as a borrowing rate, not as a return on investment. This is a return to borrowing. Now, this essentially is what we've borrowed at, the rate that we've borrowed at. And typically, we want our borrowing rate to be lower than our required rate of return. So just like the numbers flipped from positive to negative and the graph flipped, our decision rule also flips. Right now, what we want is to accept the project only if the internal rate of return is lower than the required rate of return. We see it like a borrowing rate and we need it to be smaller than the required rate of return. Because when that happens to be where NPV is positive. I've written it backwards. Because the graph is in terms of the discount rate, this is where IRR is smaller than the required rate of return. It's also backwards. Okay, so even though I don't have the discount rate, NPV greater than 0 is where I want to focus my energies. Those are the projects that I want where the NPV is positive. So we conclude, as long as the rate that we got is smaller than the required rate of return, we accept the project. So for instance, if the required rate of the return was 15%, our borrowing rate, our financing rate is smaller, so we accept the project. If not, we reject the project. So if it's 10% and our borrowing rate exceeds that, then that's not good, right? We're borrowing at a higher rate than we're getting for the project, or the required rate of return for the project. So we reject the project. So I'm going to conclude here from the two types of projects. Investment projects, you need the internal rate of return to exceed the discount rate. For financing projects, it should be the opposite. How do you know what an investment project is? When the first cash flow is a negative, and the initial investment is a negative, and all the rest are positive. So there's only one sign change. For a financing project, the first cash flow or the initial investment is a positive, showing obtaining funds up front, positive cash flow, cash inflow, and then only one sign change to make them negative when you disperse the funds. Okay, questions so far? So that's it. So you have to know the difference between financed and investment projects and the different way of making the decision. And why. All right. No questions? Okay, so here we go. What if there are more than one sign change? What happens? What if it looks something like this? So the initial cash flow, so up front, it's an investment type project where the first cash flow is a negative, or the initial investment is 260. So again, you can think of these as thousands of dollars if you want to make it seem more realistic. The next one is a positive, and subsequent ones are positive, but at the end there's a loss. This is two sign changes now. Does that change things? Well, what you're going to have is a polynomial that can curve completely. So what can happen is, if this is your discount rate, and this is your NPV profile might look like that. And what does that mean? That means that you could have two IRRs. Okay, it's two IRRs are possible. Now, the way I've drawn it could look like that, or it could look something like this. Here. So here shows that there's two possible, but here there shows there's none. There's no IRRs. What do you do? Well, we always count on NPV to tell us the answer. Since the NPV is always positive in here, you should accept this project no matter what the discount rate is. Okay, because the NPV is always positive. You see, it's always above the zero, the axis. What if it looks like this? If the project looks like this, because it falls below NPV of 0, here the NPV is never greater than 0, so you reject the project no matter what. So the NPV profile is really important when you can't get an answer on your calculator. Your calculator might show no answer. Like in this case, it'll show no answer because there's no IRR. And here as well, there's no IRR. And sometimes it'll be very complicated, or it won't have the power to calculate both IRRs. If you bought the BA2 Plus calculator, you could only get one of the IRRs. You can't find the other one with the calculator. If you have an HP, the Hewlett-Packard calculator, you can get both. I think, there's always a trade-off. I think this calculator does everything you need for the class except this. It won't give you both IRRs, but it forces the students to learn the NPV profile and not count on the calculator, which I prefer. If you had the HP calculator, you would never learn this. You never bother to learn this properly. So that's why I have you guys buying this 10B 2 Plus. So question so far? Okay, so let's see. Put this in your calculator and tell me what you get. So this is what I get. I get 11.52. Very good. But it's possible that's like Tiana's saying, we should always go through the NPV profile to make sure we don't miss the possible results. What you need to know is if there's 2 sign changes, it's up to 2. So you will work with the NPV profile until you find the second IRR. You don't have to continue indefinitely. I'll show you what I mean. So if there are 3 sign changes, you have to look for 3 IRRs. Got it? And there might not be 3. I'll show you an example. Let's say there were 3 sign changes. What if the curve is like this? It never even goes near the axis again. Okay, so even though it curves down, it happens way up here. But still, making the NPV profile will tell you that. Okay, it'll tell you the shape of the curve. So the calculator shows you one result. There's, I don't know. I'm trying to think if there's a problem that I give you where there's an error message completely for 2. So anyway, we'll get there. So let's see. This is the NPV profile for this one. So it's a long one. Obviously, if you use your calculator, you didn't need to do all of this. But just as a guideline, you can start below in the negatives just to find the IRR, to know you found it. Even though people don't use negative discount rates, right? A firm wouldn't set a discount rate as a negative because that means they're paying to conduct the project at a loss, like they're paying out. They want a return on their investment. They don't want to be paying for the investment. Or at a loss for their investment. So even though I'm using negatives, and I will even in the other ones, even bigger negative numbers, I'm doing that just to find the IRRs, to rule them out, to show that they're not up here somewhere. Okay? So it's a good rule to, I would say, make your NPV profile like very wide, like -20, 0, 20, 40, just to start, and then expand in the region where you find the sign changes. Okay? And if you don't see sign changes, then you have to even go deeper into the negatives. So we found one here, but there might be one below. You don't know which direction to go, so you got to go both directions. So we found this one. But we want to find the other one. And so I've done the profile for you, but you really wouldn't know which direction to go in. So you got to go before and you got to go after to find the other one. All right. So that you believe me, I'm going to graph this. Oh, let me tell you, for the HP, if you have the HP, anybody have the HP? The HP 10B2 calculator, what you do is you put into the interest rate, you enter into the interest rate a number like around this number. So you would put in like 25. So a number around this one. Like, obviously you don't know what that is, so wait, let me say a number. So you know the sign changes. If you did the NPV profile, you know the sign changes in here. So you could use 25 or 30. So a number near to this one, like, so a number near where the sign changes for the NPV profile, put that in the interest rate. And then ask for for it to compute the IRR. It'll find the other one. Okay, but for the HP 10B, it doesn't, I mean, for the calculator, the TI BA2 Plus, it doesn't work. So what would you do here? You would find the sign changes between these two, and on a test, in a test situation, you just tell me there's an IRR between 25 and 30. If I say to, so if I said, to give me the answer in percentage, the best answer would be between 20 and 25. No, 25 and 30, sorry. If I said you can use 2 decimal places, then you would have to expand that region. So if I said, if you need to find the answer to 1 decimal place in percentage, then you would take 25, 26, 20, well, maybe not, wait a second. So you go between 25 and 30, just go halfway, say 27.5. And calculate the NPV for this discount rate. And then you'll know which direction to go in. So you know this one was positive and this one was negative. So what happens at 27.5? So we put in, sorry, I went the wrong way. So let's put in 27.5, enter, and then compute the NPV, and it's a positive. It's a positive. So this is a positive, so it means to go now between these two. Okay, so you ruled out anything before. So you can expand some more. So now you're going to take 27.5 to 30 and go halfway between those. What would be halfway between those? $28.75. So let's do that. So we know this one is positive. We know this one is negative. Let's see 28.75. Compute. It's also a positive. So you see how this helps narrow. So it's now we're going between these two. So you can tell me that it's between 28.75 and 30, and I didn't do a lot of work, okay? I didn't do a lot of work, but I narrowed it down better than this. So you would answer in between 28.75 and 30%. That's much better than that wide range. And I didn't do anything fancy. Well, I did use my calculator to check. So because we have the calculator, we can do the profile very easily and narrow in on the answer. Okay, got it, kind of? So it's not going to be exactly as pretty as this one here, but we're close to it. And I would give you full marks for that. So depending on how I ask the question, if I want no decimals or if I want 1 decimal place, you can give me a range of values. So all we've done so far is found the IRRs, but because we made the profile, we also see when the NPV is positive. And that's in here. So we see that the NPV is positive between the two IRRs, and we need to find it or narrow close to it, get as close as we can to it to be able to say that you should accept the project as long as the discount rate is between here and here. And that's not unrealistic. A firm could set a discount rate between 12 and 30, sure. So that might be true. But the benefit of the IRR analysis is I don't have to know exactly what discount rate I want to use. It gives me a range of possibilities. Exactly, Adiette, to get close and closer to 0, to see where it crosses 0, yeah, where it gets closer and closer to 0, perfect. So you guys can watch this again because the video will be available to you. I'm going to continue showing you. Now you don't have to make, well actually I do ask you to make the drawings, but the drawings don't have to be perfect, they're just a sketch. So here's the sketch. Remembering it's a smooth curve, it's not a bumpy curve, so whatever you calculate it, you can just join the results into a curve. And here we go, this is the curve. Between 11.52 and 29.84, we make money, so I'll use green. So that's where we should accept the project, only in that case. If the discount rate is somewhere if we believe it's going to be somewhere outside of that, we should reject the project. Any questions? So this gets really interesting. You're going to see the different shapes of the curves. If you can do the technical piece, the interpretation is all rests on the NPV rule, that in here is the only place that you would accept the project. Okay, let's continue. Let's do the third one. So let's check. These are the cash flows. And they change sign. The initial cash flow is a negative, and then it changes to a positive. The next one is positive. Aha, here's a second sign change. So there's up to 2 internal rates of return. Up to 2. Uh-oh. I didn't mean to do that. So you can punch it in your calculator like that. Let's put that in the calculator and see what comes first. So I need to go to the cash flow and clear the worksheet and begin anew. 900 negative, enter, down. 1200, enter, down, down. 1300, enter, down, down. 1200 negative, enter, down, down. And then I'm going to compute, what am I going to do? I'm going to ask for IRR, and I ask to compute the IRR. Well, isn't that interesting? Let's check to make sure I entered the values properly. So negative 1200, 1300, and negative 1200. Okay, so what I got was a negative IRR. So what do I do with that number? I can't get another one, but I suspect the other IRR is higher than it. So what I'm going to do is begin the NPV profile analysis, taking note that the first one is almost negative 30. So I'm going to leave this for you to work on for a couple of minutes. So let's just remember, mathematically we're just looking for it, right? So I'm going to put a broader, let's do negative 30, let's do 0, and then 30. Let's just do it like that to begin with. Let's see what we get, positives or negatives. So so I know this one is going to be at negative 30. What is it? That's actually an interesting question. So let's put in 30 negative, enter, and compute NPV, and it becomes a negative 31. So this is negative $31. If we put in 0, and ask to compute NPV, I get 400. So that's a positive. And if I put 30, so the sign changed between these two, right? That's important. Let's put 30 in. And I get a positive. Sorry, what was that number? 24610. All right, so it's still positive. So does that mean I have to go higher? Let's try 60. So what it's telling me so far is all in this entire region, NPV is positive so far. So that's good, right? So for all of these discount rates from somewhere in the negatives to 30, it's always positive. So that's good. We should probably accept this project. Let's go higher. Let's try some crazy number. 80. What happens if we put in 80? Now it's negative. So if I'm going too fast, I'm sorry. I just need to get through this. You can watch it slower later because it's just a matter of calculations. So in here, the sign change. So I found them. I found the sign changes in here somewhere. So this was just a start to tell me what I need to do. So I need to have a number. I really need to focus on this area. And this area, I already found this one. I already know where it is. I could have checked even below the negatives, but I was pretty sure, well, I already know the answer, so I went this way. But you could even go back even further. Now again, no firm is going to pick a discount rate that's negative. However, mathematically, I need to find the internal rates of return, and they end up being negative. So let's try and find the other one in here. Let's expand that region between 30 and 80. And check the NPV for all of those. And what you're going to find is that this is going to be positive, this is going to be positive, this will be positive, this will be positive, and this will be positive, and then only here does it become negative. So it's in this region. So between 70 and 80%, the internal rate of return will be there. Yes, and on the x-axis, this is the x and this is the y-axis. The discount rate is that percentage. So this is the graph. And as I said, for all of this, let's make it green because that's where the money is. And here, the project is profitable. So as long as, that means as long as the firm uses a discount rate less than 72%, the project is acceptable. So this is a perfectly viable project. Notice I abandoned the rule that I was using before I introduced this idea of multiple internal rates of return, okay? So this is like this is the general rule to do it this way. This is the general rule. Those tricks that I taught you for an investment project, the IRR has to exceed the discount rate. For a financing project, the IRR has to be smaller than the discount rate. That rule just applied to those situations. But in general, this is how you do it. It would give you the same answer if you made the NPV profile for those situations as well. So what you say, we forget about the negatives and we say starting at 0, so between 0 and 72.525, as long as the required rate of return is between there, we should accept the project. So pretty much just accept this project already, because it's likely that that's the case. Okay, let's do the next one. Any questions? If you have the HP calculator, you can enter like 60% or 80%, overshoot the value to get it away from iterating to this one. The calculator will find this one. I think Excel has this programmed as well. You can put the cash flows into an Excel formula and it will solve it. So that's your other option. Most of you have Excel, I imagine, so you can use Excel in the test if you like. But if I ask you to draw it, you got to draw it still. So you need to learn NPV profile. So you have to teach yourself how to do that. Okay, let's do the next set of cash flows. So we need to examine it first. One sign change, they're all negative, and then another sign change. So there's up to two internal rates of return in this one too. You can make the NPV profile, and you will see that this is the NPV profile with the discount rate on this axis, and this is the NPV. So how do we interpret this? Where's the money? Where should I highlight in green? Where should I highlight with green? Right, so it should be here and here. As long as the discount rate is it's low, between 0 and 10, or it's higher than 30%, we should take on this project. The discount rate, what it's doing is affecting the different cash flows. So a low discount rate will help to make these, the low discount rate will help to make this valuable. Okay, so that is going to offset all the negatives. So a low discount rate will keep this number intact. So 0 to 10% will do that. A high discount rate will make these seem, not so bad, and keep this powerful. And since this is so high, it won't be affected by a discount rate that offsets these. So that's why, okay? So it's the size of the cash flow and the timing that determines which discount rates we like. So this for small or low discount rates for the first cash flows to retain, for the distant high cash flow to retain its magnitude. That's why this is where we accept the project. And here, that will offset. The higher and higher it gets, it will succeed in offsetting those losses in the first 2 years. All right? So that's that. That is a discussion of IRRs. So let me do the recap before I continue. For independent projects, this is what we do. So let's repeat. So internal rate of return rule, the IRR is the discount rate that sets the NPV to 0. And we're making an assumption when we do this, a reinvestment assumption that the IRR calculation assumes that all future cash flows are reinvested at the internal rate of return. So this is going to be the discount rate we'll use into the future. For independent projects, all we do, if it's an investment project, we look to accept the project as long as IRR is greater than the required rate of return. But it's different for financing projects, and we learned how to deal with that, correct? And we learned how to deal with there being multiple IRRs. We use a different approach, the NPV profile, and picking the the discount rates demonstrating that as long as the discount rate is where the NPV is positive, then we should pursue the project. And this is where we're at. Ariette, do you have the HP calculator? The HP 10B2? To get that one, you have to put in a number for the discount rate that is that goes over, to pull the iteration over to the other side. So use something like -30. It should work. Okay, so now I want to do this. I want to deal with the problems of mutually exclusive investments. So what is the problem? What is the issue? There are two problems that we have to address, and I have an approach that will help deal with this problem. One is the problem of scale. If you're comparing two projects, that's what mutually exclusive projects means. If you're comparing and choosing the best of two projects, then, or more, two or more projects, you need to take into consideration the scale problem. So here's an example. Let's say I give you one of two, one or the other opportunity. I say to you, if you give me $1 now, then at the end of the class, I'll give you $1.50. Or you can choose opportunity 2, where you give me $10 now, and then you'll get back $11 at the end of the class. So you can send it to me by ATH, and this will be the deal. Which one would you pick? And why? Opportunity 1 or opportunity 2? Nobody's answering? Nobody there? 15 people? Half the class? So which one would you pick? Somebody tell me so I can give you the punchline. In percentage terms, it looks like you would pick the first, right? Because this has a 50% return. However, in dollars, the dollar return here is 50 cents, and the dollar return here is $1. So which should I pick? You should always pick, just like we learned earlier with the IRR, we should always fall back on the dollar returns, okay? Because this is actual cash flow. This is going to be in your pocket, right? This is what it all comes down to in the end. So this is telling you to go for this one, even though the percentage return is low. So how do I reconcile this? How do I reconcile this? The issue is really that the first project is known as a lower budget project, and the second is a higher budget project, or lower budget opportunity versus a high budget opportunity. If you're willing and able to put more in, you get more out. That's not reflected with the percentages. Okay, so the IRR is a percentage, so you're going to lose that notion of scale when you reduce everything to a percentage. The NPV will always give you the right answer. So let's say I'm going to just throw in a discount rate of 0.05% and calculate these just to show you, this is better than that one, so you should pick the NPV. You should pick number 2 because the NPV is higher. If I did this with IRR, it would tell me to pick the first one. But it ignores the percentages, it ignores the scale of the projects. That's hidden in the percentages. So how do we correct for that? I'm going to show you, but first I want to talk about another problem. Here are 2 projects. What's the difference? Well, the scale of the investment is comparable, right? One is 350, one is 250. They're about the same. Well, one's bigger than the other, but not so much as the other one, the first exercise with the scale problem. The issue here is that the cash flows are initially low and then a high one in the 4th year. For project B, this pays back up front and then low cash flow in the 4th year. So what happens? Project A favors low discount rates so that this magnitude is retained. And the second project favors a high discount rate, which will make the NPV greater. High relative to A, okay? Because they really want a low one for this one. This project really needs a low discount rate to maintain the magnitude of the 200. So what happens is, if you were considering each project on its own, here's the analysis of project A. You see how I like you to do it? Just give me the IRR and then put a colon when you solve. So this is how you write it out. That internal rate of return is 12.9%. This is the internal rate of return for the project, and this is for B. It's a little bit more. So you see how B favors a high discount rate and A a lower discount rate. This timing problem, it will tell you to pick, the one with the higher internal rate of return for these investment projects. It looks like I should pick B. But if the discount rate is low, it will turn out that A would be better. if the discount rate is high, B will be better. Why is that? It plays out in this graphic here. If I was to graph these, you get to see the two projects are not parallel. Okay, if they were parallel, you could compare them, but they're not. They cross over each other. Again, A is better for low discount rate, and B is better for high discount rate. Better because the NPV is higher, you see? So these are the NPV profiles. They're not parallel. So it means that the decision flips at this crossover point. So we need an approach to deal with this problem, and the approach is going to be to create what we call the incremental project. This will correct our decision making for the scale and the timing problems. Incremental project is computed by subtracting the cash flows in each year. We're going to create the project called A over B. I think, let me double check, I call it A over B. Okay. So we're going to create what's called project A over B. So what we do is we take A's cash flows in each year and subtract them by B. Okay, so I subtracted 350 negative minus 250 negative. And then 50 minus 125 is negative 75. Okay, that looks really bad. Let me make this bigger. If you need to refresh your screen to make it sharper. And then this will be 0, and then this will be 75, and this will be 150. Okay, so those are the cash flows for project A over B. So we've combined these cash flows into a new project. If we accept it, it means we should pick A instead of B. In place of, in place of B. So analyze, now we don't have to analyze these ones. We go to analyzing the incremental project cash flows. So punch those into your calculator. What do you get? Oh, I'm still talking, and some people, I'm over time. Okay, I did start late, so let me just tell you what you get. If you have to go, that's fine, get going. You can watch the video later. So when you put these into your calculator, clear your work. So if you compute the IRR, you get 8.07. What is that? 8.07 is the IRR of the incremental project. Choose A instead of B. It's actually giving you this right here. Let me put that in darker color. Okay. So yes, you should pick A instead of B. Here, because A is better than B. But you should reject it otherwise. So how do I know what to do with 8.07? Here's slide number 33. This is a summary slide. So what I'm doing is I'm combining these cash flows here into this incremental project, A over B, and that creates this bold line here. I ignore these two lines now because they've been subsumed in the thick black line. And the decision will be then to pick, because this is the IRR, this is what it ends up, this is what I computed. I computed the IRR of A over B, and it says to choose project A over B as long as the discount rate is exceeded by this. So as long as the discount rate is in here, you should use A. If the discount rate is outside, then you should choose project B. Okay, so all the stuff that we learned before, now with mutually exclusive projects, this is how we deal with mutually exclusive projects. Different from independent projects until we subtract them, and then we analyze this as though it's an independent project, telling us to take A instead of B. Okay, so the only other thing I have to talk about is the Profitability Index. And let me just say it like this and leave it with you for the week. We learned about the NPV, which is dollar amounts. We learned about the payback period and the discounted payback period rule, which gives you the number of years. Then we learned about the internal rate of return, which is a percentage. And finally, we're going to talk about the index or ratio that is the Profitability Index. Okay, so with the Profitability Index, we what we're doing, rather than with the NPV, we're offsetting cash flows to see if the returns in dollars is better than the investment, if we do better. For the percentage, we're doing the same sort of thing. We use the NPV rule. It's part of making the IRR decision. with the profitability index, we're taking the benefits as a ratio over the cost. That's what we're doing. So all of these calculations for dollars per percentage or for this ratio is looking at benefits versus cost. And the profitability index creates a ratio to achieve that. The ratio is basically that. Take the benefits. This is the taking the net present value and adding back the initial investment divided by the initial investment and seeing if it's profitable. In this case, you calculate for this exercise 1.2, which is greater than 1. As long as the profitability index is greater than 1, you accept the project. The profitability index suffers from the same problem as as the IRR for mutually exclusive projects, so you can also do an incremental project analysis to get the right answer. So I'll leave you with this. I just have a couple more slides to finish next class. You should be able to review the exercises I sent you. So prepare those for next class and bring me any of your questions. You can email me about any questions you have. One of the exercises I sent you, one of the documents has no answers, so I like to give you some challenging problems that you can prepare for next class. So work on that. Let me see if I want to see. No, I didn't put them here. Okay, so that's that. Okay, so good luck. Have a good week. Keep in touch, and I will let you know about your tests. Ariette is asking about the other calculator. Do you have the HP? Ariette, because it's only with the HP 10B2. So you have, okay, yeah, Ariette, you cannot get both on the BA plus. What do you have? BA plus Pro. I don't know which calculator that is. BA plus Pro. Is it? Just tell me if it's one of those two. If it's not, the only calculator that you can get both IRRs is the HP Hewlett-Packard 10B2 Plus. I don't know any other calculator that does that. Let me see if I can get it here. No. Oh, here. HP 10, it doesn't say HP, 10B2, but it looks like it. Let's see if I can do it. Let's see. I just bought the calculator. Didn't they tell me the price? Touch the key twice to learn how to use the calculator. Okay. All right. So for this one calculator, I have to set up the format first because it's all wrong. So if I do, okay. So that changes the calculator, the decimal places on the screen. And then I need to make sure my periods, I need to remember how to do this. See, because it's 12 here, I need to make that one. I don't completely remember how to do this. No. So second, I'm trying to change the timing. Oh no, that's not right. Wow, that's not good. Okay, forget about that for now. Let's, so second clear all. Second clear all. I don't know. So if I was to use the, yeah, no. I'll have to change that. So if anybody wants to go, you guys can go. I'm just going to try and tackle this. I don't remember how to do this. I have no idea. I don't know how to fix that. So anyway, that's going to create a problem already. I'll have to, Adiad, if you really want that, you're going to have to wait. Because I'm going to have to learn how to do it on this calculator. If it even works. I don't even know if it works. Okay, so well, it doesn't seem to do what I want. So let's see if I enter those values, what happens. So I'm going to do these ones, 900. So if I enter cash flows, honestly, I don't remember how to use this calculator. I don't even know where the negative sign is. That's not it. Anyway, I'm going to have to close this demonstration. Ariette, you're going to have to research just like me how to use your calculator if you insist on finding it with the calculator, okay? Because it's not required in the course. You can use the NPV profile. But I'll try and figure out how to do it on the calculator so you can see it next time. But it's going to take me some time. And I don't even know if this is the HP 10B. It just says 10B2. It's supposed to look like it, but it's not doing things the way I'm used to doing it. Okay, so good day. Have a good week. Be in touch. Bye for now.